All right, we've got a lot to cover, but first, investors are weighing a fresh reading on the economy. GDP for the first quarter clocking in at 1.3%, in line with expectations, but down from its initial reading in April. The reading comes at a time when markets have been sensitive to any data that can help inform the Fed's decision on rate cuts, as inflation has proved stickier than expected. So, how can investors protect their portfolios in this current environment? Anthony Saccaro, who is the Providence Financial and Insurance Services president. Great to have you here with us this morning, Anthony. First and foremost, you see a print like this come off in GDP, at least in the revisions that we were able to see come through as well. And what goes through your mind as to how the economy is faring right now, even in the face of stickier than expected inflation, particularly in some of the services areas?
Well, the economy is faring well, and that's part of the issue. Everything is softening, but inflation is the one thing that is just still sticking around. When you look at inflation data, it's stuck in that 3.4% range for the last couple of years. You look at the labor data, and I think that's one of the biggest areas of stickiness. Or of concern when it comes to consumers, is that labor that has softened, but it's still strong. If you go back a couple of years, there were 2 jobs available for every worker. Now I think it's 1.3 jobs available for every worker. So that's coming down, but the unemployment rate's still in that 3.9% range. But the labor market is a big reason why the economy is so strong. GDP has come down, as we noticed, right? Last print, 1.3%. But the consumer their expectations have risen. The CCI came out just the other day, and their expectations are stronger than they were before. But the savings rates are going down, credit card rates are going up. So there is just really a mixed bag at this point with the consumer. There's a lot of things to take into consideration, though, but the higher rates, the higher inflation stays, the softer the consumer is going to become. And that's probably the biggest worry about the future, is the strength of the consumer.
Current dollar personal income, that actually increased $404.4 billion in the first quarter, a downward revision of $2.6 billion from the previous estimate here. And the increase, they say, in the first quarter was primarily reflected by increases in compensation, coming back to the wage front that you were mentioning there, and led by private wages and salaries here. So what is the kind of evaluation of where we stand on wages and where that's continuing to moderate right now, and the pass through to the consumer mindset?
Well, one of the things that you have to know about inflation is there are some areas where inflation can come down and go up and kind of fluctuate as necessary. Energy is one of those areas that can go up, it can come back down. Commodities, they can go up, they can come back down. But wages can go up, but they can never come back down. I'm an employer, and over the last couple of years, when we've had so many jobs available and so few workers have felt like they can write their own ticket. They feel like they can go somewhere else. If they don't like you, they can kind of give you the finger and in that way, and they can move on. And the bottom line is go find another job. That's softening a little bit, but there's still a lot of jobs available. But I've had to give raises to my staff to keep them. And you can't give a raise a year ago because wages are up and inflation's gone up. And look, I got to keep you, so I'm giving you a raise. And now all of a sudden, everything's come down. Try going back to my staff and telling them, look, guys, inflation's down. I'm going to take your raise away. No, it doesn't work like that. You can't take that back. But guess what? That has to be passed on the consumer. And I think that's what a lot of people don't understand. Is that those wage increases, it's the biggest expense on most companies' bottom line. It can't be taken back. Once you've given a raise, you're not going to get rid of it. So that's a lot of what's causing this sticky inflation.
Anthony, we want to kind of look forward to tomorrow and PCE, what we're expecting there. If we get a hotter than expected read on PCE, what does that do for the Fed's mindset?
Well, the Fed is in a pickle right now. The Fed is trying to figure out, how do they lower rates? They want to lower rates. They've said that at the beginning of the year, but they have to have the economic data to lower the rates, and they're not getting that at all. Their mandates are 2, right? Full unemployment and low inflation. The unemployment, they got that under control, the 3.9%. It's the inflation that they can't get under control. Now, they say that their price target is at 2%. I don't know that they're going to get to 2%. They don't need to get to 2% before they act, but they can't have it going up. So the fact is that if the PCE comes in hotter than expected, they're not going to be able to lower rates. And I think one of the Fed presidents, maybe it was Kashkari, recently said that rate increases aren't off the table. They got to get this inflation down. So a hotter than expected PCE print is not going to help anything for sure. They're not going to be able to lower rates.
Anthony Saccaro, who is the Providence Financial and Insurance Services president. Thanks so much for taking the time here with us, kicking off today's show.
Thank you, Brad.
Certainly.